Stablecoins look boring at first, just money moving from point A to point B, but in reality, they are one of the main forces behind everything happening in crypto. Liquidity, trading, panic, rotation, DeFi activity, all of it leaves footprints in stablecoin transfers. So in this video, we're gonna take raw USDT and USDC data and slowly turn it into real on-chain metrics using SQL. We'll use these two stablecoins as a foundation for our final dashboard later. We start with something simple but very important. We're using the Ethereum ERC20 transfer table. This is basically a full log of token movements between wallets. From this table we only keep two assets, USDT and USDC. At this stage there is no analysis yet, we're just defining our dataset. Who moved funds, when it happened, and which stablecoin was involved. And we limit the time window to the last 180 days. Our first metric is volume, the one we already built in the previous video. We reuse the same dataset and group it by day and token to track how activity evolves over time between USDT and USDC. Then we aggregate the value field. It represents raw transfer amounts in smallest units. So we normalize it by dividing by 1/6. Now we get daily volume per token. We visualize it as a bar chart. And reuse this structure across all metrics, only changing the y-axis. Looking at volume, USDC leads in total transferred value over this period. Now we go one step deeper, we keep the same dataset and grouping logic, but add one extra layer. We calculate total daily volume across both tokens, then normalize each token's share by that total. So instead of absolute values, we now get percentages, daily market share. So now we're not looking at money anymore, we're looking at usage. We're no longer asking how much moves, we're asking who controls liquidity each day. And the picture becomes more dynamic. There is no single dominant player here. USDT and USDC rotate over time. What looked like a stable market in absolute terms. Now we shift the metric completely. Instead of value, we look at usage frequency. Same dataset, same grouping, just a different lens. We replace sum with count. Because volume alone can be misleading. A few large transfers can dominate everything. But transaction count shows something different, how often the token is actually used. So now we separate capital flow versus usage intensity. In this view, USDT and USDC behave differently. One may lead in volume, the other in activity. Now we move from transfers to users, we switch the dataset slightly. Instead of token transfers, we look at Ethereum transactions going to USDC. And we count unique senders per week, so now we are measuring active users, not flows. Then we calculate week-over-week change. Why? Because raw user count alone is not enough. We want to see acceleration or slowdown. First I queried the USDC contract and checked the chart. Then switched to USDT and rerun the same query. Now we can directly compare real usage between USDT and USDC. Positive values mean adoption is increasing. Negative values mean usage is cooling off. What we see is important. User growth doesn't move in a straight line. It comes in waves and then cools off quickly. Which means stablecoin activity is reactive. It follows market cycles rather than growing steadily. So if we zoom out, volume shows scale. Market share shows balance. Activity shows usage. User growth shows adoption. Before we jump into building the final dashboard, we'll take a lighter step and talk about visualization for analysts, how to pick the right charts and keep dashboards clean and easy to read. Also, you might notice we skip the more hardcore topics here: raw log decoding, arrays and unnest, MEV, NFT analytics. Not because they're unimportant, but because that deserves its own deep dive series later. And if you made it all the way here and survived my English, I'm proud of you. See you guys.